Hello everyone, welcome back to the channel. This presentation is brought to you by Synergy Business Advisors, Noida, your trusted business mitra providing complete advisory solutions. Today we are discussing a very important and clear judgment that sends a strong warning to the promoters and directors. Let me begin with two critical questions. Can you simply write off inventory in the books to clean up accounts before insolvency? Can accounting entries erase past misrepresentation and misleading financial disclosures? The NCLAT's answer is a clear no. The issue was examined in the case of Shri Balakrishna Paranjape versus Shri Ajay Marathe, discharged resolution professional of Paranjape Agro Products India Private Limited and others. In this video, we will discuss and understand the facts of the case, the legal issue involved, how Section 66 of IBC applies, and why this judgment is extremely important for corporate stakeholders and insolvency professionals. Facts of the case: Paranjape Agro Products India Private Limited entered into corporate insolvency resolution process under IBC. During CRP, the resolution professional examined the company's books and noticed something alarming. A large quantity of inventory was written off. The written off happened just before the initiation of CRP. On verification, it was found that no physical stock actually existed. In other words, the inventory shown earlier in the books was not available on the ground. The explanation given was simple. This write-off was done only to clean the books of accounts. Legal issue. Based on these facts, the key question before the NCLAT was, does writing off non-existent inventory merely for books cleaning amount to a fraudulent transaction under Section 66 of the IBC? Before we look at the NCLAT's findings, let us briefly understand Section 66 of the Insolvency and Bankruptcy Code. Section 66 deals with fraudulent trading and wrongful conduct. It applies where the business of the corporate debtor is carried on with intent to defraud creditors or for any fraudulent purpose. Under Section 66, the adjudicating authority can hold promoters, directors, or officers personally liable if their actions have reduced the value of assets or mislead creditors. In simple terms, if financial statements are manipulated to present a false picture of the company's assets, Section 66 gets triggered. The NCLAT gave a very clear and strict ruling. The tribunal held that writing off inventory that never physically existed is not a routine accounting adjustment. Such write-offs are meant to wash earlier false entries. Inflated or fictitious inventory shown in earlier years misleads creditors about the company's true financial position. The NCLAT categorically observed accounting entries cannot be used to regularize fraud. The tribunal further noted that if inventory is written off only to clean the balance sheet, it clearly indicates one of the two possibilities. Either the stock never existed or it was diverted or siphoned off. In both the situations, the conduct amounts to fraudulent trading and squarely attracts Section 66 of the Insolvency and Bankruptcy Code. Based on this reasoning, the NCLAT held that writing off non-existent inventory solely for book cleaning constitutes a fraudulent transaction under section 66 and persons responsible can be held personally liable. Key takeaways from this case: for promoters and directors, you cannot hide fraud behind journal entries. For resolution professionals, pre-CRP inventory write-offs are a major red flag and must be examined from a fraud angle. For auditors and advisors, physical stock verification is critical. Books alone are not enough. That is a wrap on this significant NCLAT ruling under section 66 of 5BC. This is CA&IP Praveen Agrawal thanking you for watching. I hope this presentation will be helpful for you. Please subscribe to the channel for more such informative videos. Thank you.